Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. Welcome to the New Home Insights podcast. I'm Dean Worley. There have been some prominent, let's say, aggregations recently in home building, so we thought it was time to talk about that again. Bob Crowley is managing director at Moelis Company, a global investment bank with a presence across a wide spectrum of sectors, but Bob focuses on housing, so he's with us today to chat about the world of housing mergers and acquisitions. We'll get into some major M&A events recently, into the nuances of what makes these things work or not work, but Bob has been at this for a minute, so we're also going to have some stories, from his experiences over the years. Bob, how are you doing today?
Dean, I'm great. Thank you for having me.
So before we get to those war stories, let's just talk about your journey to Moelis & Company, and sort of what is, in a big picture way, what does Moelis do these days?
Sure. So maybe I'll start with what we do. So as you mentioned, we're a global investment bank, and what that means for us is 60% of our business is M&A. So we help companies either sell themselves or buy other companies. And then about 20% of our business is restructuring, which, when times are tougher, like the global financial crisis, that can be a much larger percentage. And then when times are better, smaller. And then the balance of our business is what I call kind of boutique capital raising. So if someone needs to raise money and they can't get what they need from traditional commercial banks, and they're maybe a little small to go to the public markets, they want to raise between, say, $50 and $200 million of debt or equity, we can be helpful there. So we have offices around the world. I think about 25 offices. We have about 1,500 people, and we cover all of the major industry groups. Before you get to your background, Bob, I love that $50 to $200 million is boutique, just kind of, some pocket money. That's the days we live in. Right. That's right. So, well, for the home building industry, it usually translates to fast growing private businesses that may aspire to be public someday. And they just need a little bit of, kind of rocket fuel to help get them there. Nice of you to provide that fuel. So go ahead. How about your 30 plus years, I believe, journey to where you are now? Sure. So I started 95 on Wall Street at Salomon Brothers as a high yield research analyst. So basically it's like a equity research analyst, except not as sexy. And so I would write research reports about the high yield bonds of home builders. So companies like US Home and Del Webb and Ryland and Stanpack, and then also companies that are around today, Beazer, Hovnanian, Meritage. So for about 5 years, I was a research analyst. And then at UBS, where I had moved as an analyst, I moved out of research into investment banking. As it turns out, Alan Merrill, who is the CEO of Beazer, used to be an investment banker at UBS. And when he moved and left banking, I was fortunate enough to move into his position. And so I've been doing that ever since about 2000. And while
Alan, friend of the show, by the way, he's been on.
Yes, I'm sure he was great. And while I was at UBS, I was fortunate to meet Ken Moelis, who founded our company. And so in 2007, Ken decided that he was going to leave a bulge bracket firm and start his own business. And so I was one of his original partners, and we started with about 20 of us, and that was in 2007. And so, as I said, we're up to about 1,500 people today. But one interesting note is that because I was there at the start, home building isn't the biggest sector out there, but for our firm, it has been one of the most active and one of the most important. So since we were founded, home building has always been, an important sector for us.
That's interesting, Bob, because actually your firm, Moelis & Company, has its hand in every single pretty much development sector in the world, and it's a global company. So it's interesting that housing is so important to you folks there. So let's start with, I think, it's kind of topic du jour. It's how these Japanese firms, these major Japanese builders have built such a huge presence in the American home building market. Why are these Japanese firms so enamored with American real estate? Just let's start big picture with what is motivating them to want to be here.
Sure. So big picture, there are a number of housing companies in Japan. You're familiar with some of the names: Daiwa House, Sekisui House, Sumitomo Forestry, and they've all been around for a number of years. And I think, like a lot of Japanese consumer products companies, recognize that the US market is larger and faster growing than Japan. And so, not dissimilar to Toyota and Honda or Panasonic or Sony selling more products over here. Obviously, building a house is different, but the marketplace, as it relates to being faster growing and larger, is similar. And so they're not only in the US, but I think that as they've poked around places like Australia and China and Southeast Asia, Europe, by comparison, the US market is much bigger, deeper, better margins. So I think it makes a lot of sense for them to be here.
Do you think that population growth kind of slowing down here in the US? Because remember, a lot of that has been in the recent years driven by immigration. That's slowed down pretty dramatically. Do they still see this as a growth market, the US as a growth market, do you think?
I think they do. I think that even if our market were relatively flat, which I don't think it will be, especially given the undersupply that's taken place and sort of the catch up. But even if we were flat, it's still a much, much, much larger market than Japan is. Yeah. And their market shares, even though they have done a number of deals and have gotten much larger recently, still relatively small. So I'm sure they believe that even without the growth, that there is a decent amount of share that they could take. And that's what they've been doing. Yeah, so I think they'll continue to do that.
I'm glad you said that, because I work in a lot of markets where there is very limited growth and they're basically done. But in terms of there's infill opportunities, there's not a ton of natural or any more immigration growth. But people forget that you don't have to have high growth to have a demand for new homes. So that heartens me to hear your answer about that. Now, let's get into some of those war stories. You go way back in terms of your experience with Japanese, all the way back, I think, as least as far as about 2009 with told me this earlier. We talked about it earlier. Sure. You have a great story about one of your first experiences in Japan.
Sure. So it kind of goes back to that 2009, 2010 area. And when Moelis Company was still private, we formed an alliance with SMBC Bank in Japan and SMBC Nikko, which is their investment banking subsidiary. And so that's kind of one of their big three banks. And we formed an alliance basically to collaborate so that our clients here in the US could try and leverage their bankers in Japan and vice versa. And so I remember when internally we announced that alliance, and my immediate reaction was there's probably not anyone at the firm for whom it would be less beneficial than for me. Because at that point, and this is 10, 15 years ago, it was not at all on my radar screen that there was any Japanese interest in the US housing market. But quickly, I met some of my counterparts and they said, no, it'd be great if you could come over to Japan because we actually have some home builders over here that have an interest in the US. So I remember my first trip over there was, I think, in 2011. And it was right after the tsunami and Fukushima disaster. And so I'll just always remember it based on that. And so since then, I've probably been over there 20 or so times, maybe more. And it's become an incredibly important part of our business from a time when it really wasn't even remotely on my radar screen until I first went over there.
So you've been at this Japanese interest in U.S. home building for over 15 years, because to a lot of folks, it does seem like it's relatively more recent than that.
Yes. And if you read, now it's sort of on everyone's radar screen and, you see the Wall Street Journal and other places picking it up. But the reality is that these companies have been over here kind of moving slowly but deliberately for about 15 years. Okay. And so I remember very early on meeting the head of Daiwa House's overseas business. This is probably in 2013, 2014, something like that. And met him in New York. And he said, if you're going to advise us, or if because we were talking about different ideas, and he was like, if you're going to give us a good idea, you really need to know us better.
Yeah.
And so he invited me to go over to Japan, and we spent 3 or 4 days together traveling around really the whole country, seeing not only their home building sites, but also manufacturing sites, logistics centers, hotels, gyms, senior housing facilities. And it was really fascinating. And today, that led not too long thereafter to them acquiring Stanley Martin, which we advised Stanley Martin on that transaction. And today, the person who ran their international business is now the CEO of the whole company, in part, I think, I would guess, because of the success that they have had expanding over here. But they're very deliberate, very thoughtful, very long-term focused. Yeah. And so to get to these more recent big deals that have been picked up by the press and is on everyone's radar screens, it's really been the byproduct of at least 10 years of kind of slowly taking smaller steps that have culminated in some of these bigger deals.
Yeah. Some of your words are echoing. We had David Vizir from Sekisui US on just not that long ago. And the deliberateness and the kind of the longer term perspective is very much what he talked about as well.
Mm-hmm.
How about, we have Daiwa, we have Sumitomo, we have Sekisui in the news recently. Is there another group, a next gen of Japanese builders that it might also take a look at the U.S., or might that be it for a while?
It's a great question, and certainly one that is, I think, front of mind of every investment banker out there. And we'll see. There are some other Japanese firms that have started to stick their toe in the water. You've seen Ida Group and Misuwa and Itochu and Asahi Kasei all sort of make smaller plays, which really are not that different than the types of moves that the Daiwa and Sekisui House and Sumitomo Forestry were doing 10 or 15 years ago.
Okay.
So it'll be interesting to see what the follow through is and whether or not they too or maybe some other companies would emerge as big players.
Yeah.
But there's a lot of daylight between what I'd call the big three have accomplished and where everybody else is right now.
Do you think they would go for kind of the national footprint that it appears the big three have gone, or might they go for something that's maybe a little more niche or a little more geographic?
I don't know. I think it really depends upon what their longer term objectives are and how successful they are in taking their initial steps as to how far they take it. But, it's really interesting. Like if you were to look at a US company, and it was, 20 years ago when there were US builders that had international operations, right? KB was and Beazer were in Mexico, Pulte was in Argentina and Puerto Rico, Centex was in the UK, KB was in France. Like it wasn't unheard of, but the scope of those operations were much smaller than you'd never confuse the fact that their core market was the US and that those were kind of, much smaller pieces. But it's really been striking to see, particularly in the case of Sumitomo Forestry, how basically they have become much more heavily weighted to the US than they even are to Japan. If you were to ask that question of a US company, you might say, well, there's some natural ceiling as to how much they want non-US business to be part of their total. There doesn't appear to have been any kind of a upper cap in terms of how big they're willing to let some of these businesses get here, which is interesting.
Yeah. Okay. So more generally now, what best characterizes those builders who have this appetite for M&A? What is driving that desire?
Well, if you go back, I don't think it is a function of the times to say that what is driving M&A today is geographic expansion, because I think that's what very, very large percent of all M&A in the sector, I think, is generally driven by somebody who says, I want to be in a different market.
Mm-hmm.
I'm not there now. I'd rather not pay the dumb tax. And so as opposed to cobbling together the inventory on my own, I'm going to go buy somebody. So whether you are looking at deals that are happening today, or if you go back and look at what was fueling Lennar and Horton's M&A strategies back in the 90s and early 2000s, or, most other examples you could come up with, I think it's generally focused on wanting to get a successful business set up in either one market or maybe many markets that you're not currently in. And I think that sort of describes why more recently the bulk of the M&A activity has come from companies like the different Japanese builders, or you could put Clayton in the same category, which are companies that initially had relatively small footprints, but wanted to get into new markets. Whereas the guys who were big acquirers 10, 20 years ago, but now have national footprints, M&A is not as meaningful for them. So it's a long-winded answer to your question, but I think it's largely driven by geographic expansion.
Yeah, and that makes sense. This next question is a little weirder because these folks may not be coming to you. You're not talking to these folks, but do you think there's anything that characterizes those builders who do not want to be involved in MFA, who are a little more risk averse? Are they, worried about their balance sheet? Are they just worried about risks? Any sense of that?
Well, yes, and it's not weird because I would say that most builders are not that acquisitive as it relates to them. So it's, as an M&A banker in this sector, you really have to pick your spots because it's not as if it's this sector like others where there's just constant M&A activity. I think most builders realize that, in most cases, if you're buying another business, the first thing you look at is, well, what's the underlying value of the assets? And just like you would a land deal. And if you're getting into a new market, if you think the people are really good, you may be willing to pay more than what the assets are worth. But at its core, builders are buying and selling land all day, every day. So I think they tend to be very disciplined when it comes to their approach to M&A, because they know what they're targeting in terms of returns and asset values. And like I said, sometimes people will pay more than that, but I do think it generally comes from a pretty disciplined acquisition philosophy.
Now, you said something just a second ago that kind of piqued my interest. Is there, beyond geography, is there something like human capital and human assets that folks are looking for when they are looking to acquire?
Yes, I think that there's general acknowledgement that in this industry, the people are critical and that the assets come and go, but that if you have the right people, they'll replicate assets many times over. So in theory, if you could pay a reasonable price for a collection of assets, but get great people, well, then you could afford to pay much more for that single set of assets because you've got the people in place to repeat it over and over again, which would be super valuable.
Yeah.
The problem is that builders are really good at valuing land, but it's hard to value people.
Yeah.
And even if you know it to be true, especially because you may hire the people, but you don't own the people. So, there's no guarantee that people are going to stick around. So I think everyone knows that a great team is incredibly valuable, but sort of how you procure one through an M&A deal is challenging.
Yeah. And how you keep them, how you make them not scared because usually there's some attrition there in most M&A. So that makes sense.
Exactly.
Circling back to the geography question, though, I mean, for the most part, folks are looking at the quote unquote hot markets, the high growth markets, the markets with positive job growth, things like that. Is anyone sniffing at those not historically hot markets that have honestly been standing up pretty well these days?
Yes, I think you kind of pose the question well for however long it's been, for a long, long time. The smile states have kind of been where it's at, but it was almost too much of a good thing coming out of COVID. So now the best markets are some of the softest. And so I think as a result, the less sexy Midwest, for example, I think is definitely on people's radar screens. You've got some of the Mountain West places like Utah, Pacific Northwest. So I wouldn't call any of those traditional smile markets, but I think are definitely on people's radar screens.
It's kind of good to hear too, because there is, for sure. The smile states have been where all the attention is. And don't get me wrong, for sure, those places are going to recover. But right now, a lot of those places are oversupplied.
Yes. And I think that, it's in times like these where geographic diversification on the part of larger builders can pay dividends, because if you're only in Phoenix, Houston, Dallas, and Atlanta, when it's good, it's good. But if you're concentrated in all of those markets, cool a little bit, it can just be more challenging.
Tell me if this is off topic, but how do you think most builders, when they do acquire, feel about sort of centralization and branding? Do you think typically they are going to want to make sure everybody be branded under one name? Or do you see some of those actors wanting to keep those brands, especially when they have local value?
It's kind of a mixed bag, and I don't think there is a rule of thumb on that. I think it's more case by case. Okay. So I do think that there are certain things where I think the bigger builders have made real progress over the last 10 years or so. I think they've become very good at figuring out what decisions should be left at the local level and what decisions should be centralized. So that the easiest one is if you can get everybody on common systems, particularly if you're a public company, that's a no-brainer. It's maybe hard to do, but ultimately, if you can get everyone on one system, that is systems, that's great. If you can get legal, accounting, HR, marketing, things like that are scalable and leverageable, that makes sense. I think when it comes to purchasing, maybe a little bit, certain levels, but when it comes to product branding, which touches on what you were asking about, I think that is more of a decision at a local level. That's not to say that everybody will choose to keep it a local decision. Obviously, there's some really big national brands out there that, if they buy someone, they pretty quickly flip it over to whoever it may be.
Yeah.
But I think that's more of a case by case.
That's the part just going to one of the most successful consumer companies in the world, Frito-Lay. People think when they walk down the aisle at the grocery store, they probably don't realize, something like 50 or 60 or 70% of those items are from Frito-Lay, but they might be called Tostitos and Cheetos and Ruffles and stuff like that. I always wondered why builders don't keep those brands in local areas when they do have a really good reputation.
Yeah. And I think, I think people debate that all the time. And like I said, I think it's hard to say that there's a right or a wrong answer to that.
Okay. Let's go into delve into the guts of these deals. What is the most likely deal breaker, or at least a hurdle, when you are negotiating some kind of an M&A?
I think the hardest one, it's probably the most obvious one, which is price. And so the more nuanced answer to that is managing the expectations of both the buyer and the seller. I think sometimes as a banker, there can be a tendency to want to bring parties together and, want to set up a dinner, want to generate momentum and activity, and want to believe that there's a there when it comes to deal making. But I do think often in doing that, you sometimes can create false expectations on both sides. And so I think most often things fall apart because someone's expectations have been mismanaged. And that could either be the buyer or the seller. So I think that's the most frequent one. I think a couple of others would be, and this isn't public versus private, but usually you see a wider range on the private side, is the quality of their systems and information. I'm sure you've heard the saying that time kills all deals. And there's definitely some truth to that. And I think the long pole in the tent from a due diligence perspective is often the ability to produce information. So some of that is anticipating upfront what information buyers would need to conduct their due diligence and kind of organizing that in advance. But clearly, some companies just have a better ability than others to sort of produce information, and that can slow you down if you're not well prepared in advance.
I can see how time would leave people and they just start mulling it and they start thinking of you're probably going to think of more bad things than good things. Bob, how about mortgage rates as a hurdle? The heightened mortgage rates we have now, has that been any kind of a hurdle to M&As?
I think probably less than you think, because M&A isn't necessarily, when times are really good, so let's assume rates go really low, times are really good, people usually aren't motivated to do deals, maybe a little counterintuitively. But the reality is that if things are going really well, you're not really motivated to change. And conversely, if things are really bad, that's a tough environment to make big decisions in. And so the mortgage environment we have now has been pretty consistent, for better or worse, for the last few years. So I actually don't see them as a stumbling block to deal making right now.
Kind of a related question, but what is the state of capital right now for home builders?
It's pretty good. Market volatility can limit access to capital. So with the war, with some of the noise around private credit, those types of things have the potential to restrict access to capital. But the reality is that it hasn't yet. And I think that if people wanted to get financing for deals, it's readily available right now. So I could bring up a case where capital could become tighter, but we're not there now.
What would that be?
Well, if you saw, if you rolled the tape forward and inflation became more of a problem, and some of the rumblings around private credit became a bigger issue. And so if we went into an environment where there was more market dislocation, stocks are down, credit spreads widen, then that's an environment where it's usually tougher for banks to make big commitments for deals. Whereas conversely, when Sekisui House raised their money to buy MDC, when Sumitomo Forestry was raising their money to buy TriPoint, we didn't see any challenges in assembling that financing for two very large deals. So capital is generally available.
Okay. Yeah. I mean, most people who have now heard of a blue owl have only heard of that in the last few months or so. So that's interesting. We'll see how that tracks. Let me ask you to put your crystal ball on here. And near term, say the next 2 or 3 years or so, do you see continuing M&A in the building world?
I do. I think that there's sort of a natural cycle of companies building great businesses. There's a generational component to it. So you always have businesses where the founder decides, now is the time to take what is probably a big chunk of their net worth and take those chips off the table. So I think you'll continue to see that kind of activity. And then, the other activity that we haven't seen much of historically, in part because of what I said earlier, that usually the foundation for M&A is more about buying assets as opposed to buying people or trying to extract synergies. But it's really obvious that the largest builders command significant premiums to the mid and small cap builders. And we get a lot of questions as to why don't you see some of the biggest companies that are trading at high values buying some of the smaller companies at lower values. And so it's hard to predict that we necessarily will see a wave of consolidation of the big guys hoovering up the small and mid cap guys, but it's certainly something that gets a lot of discussion.
Is there any way to change that? I mean, A lot of this is perspective. A lot of this is expectation by folks who are following these stocks and these things like that. And we live in this very, very heightened, quantified world. We all love data. We do too. We follow the data. But I don't know, is there any place for nuance when folks are looking at these companies? Does that ever enter the picture when you're assessing companies and when folks you're dealing with are assessing companies?
We try to. I feel like if you're a public equity investor, you probably have a million different things that you're following. And I'm sure when you look at the builders, everybody kind of sounds the same. And so I feel like they tend to use kind of blunt instruments in terms of figuring out, should I buy this one or sell this one? There's such a tight correlation between book value multiple and ROE. But you know that there's a lot of variance in terms of how the companies generate that ROE and their market positions and their track records and their balance sheets and their people and all sorts of things that I think if you got to know all of these companies well, you would point to as being pretty important factors in how the company does. But it is incredibly, you don't see that in the valuation. And so that leads me to say, I don't think there is a ton of nuance when you look at where the stocks trade and what the companies are doing, which I think the companies themselves find kind of frustrating because, they obviously spend a lot of time trying to tell differentiated stories, but at the end of the day, it just sort of boils down to your ROE.
Bob, I think you're right. I think builders do get very frustrated with this focus on the numbers, and there aren't that many builders, home builders out there, decent sized home builders at the end of the day. And I think a lot of them feel like they have a story to tell, but no one's listening. So your comment, I think, will, find some receptive ears. Circling kind of back to M&A in general, near term again, your crystal ball. You mentioned that you do think there'll be some continuing M&A. What do you, just big picture, what's going to be driving that? Is it just continuing to be geography, people too? Will it be like product or execution, anything like that?
I think it's all of the above. If I were to introduce sort of a new thread other than just either geographic expansion for the buyers or private guys deciding to take chips off the table, I would say the importance of scale in an environment where gross margins are hard to come by. Like it's hard to get price right now. So I think when it's hard for margins to expand on the gross margin level, the importance of all of your costs become amplified. So if you can buy your stick and brick cheaper, if you can spread your overhead dollars over more deliveries, if your capital costs are lower because you're borrowing for less, all of those become a bigger advantage. And so I do, on the part of both public and private builders, in an environment like today, I do think that if there were an opportunity for someone to join forces with somebody else and think that they could improve their cost structure, that there's potential interest in doing that.
Okay. How about land? You mentioned balance sheets a minute ago. That makes me think of the almost mania among especially the very large public home builders to keep their land off balance sheets. Do you see that changing? Is that still going to be really important to them going forward?
Yeah, that's a great question. I think that land banking is a tool. I think most builders recognize that there can be a time and a place to use that form of capital in the same way that you would use any other form of capital. If you're buying land, you could use bank debt. You could potentially use some form of equity. You could use high yield bonds. You could use your own internally generated cash. And I think land banking sort of belongs on your list of things to consider. But I do think some of there's such buzz around asset light and doing all of your business through land banking. I think that is, there's probably less interest in doing that now because it's expensive. It's got cost associated with it, both in terms of the cost of your lots and the structure. So I think it'll be a tool going forward. I'm just not sure there's as much buzz around it today as there was the last couple of years.
Yeah. And the folks who do a lot of land banking will tell you it allows them to kind of leverage their money. And they can do a lot more activity with less of their own capital when they land bank. But in terms of activity, that's a little bit down these last year or two as well.
Yeah, they can. They definitely can. But then at some point, you have to have the means to take down that land that you've signed up for. And I think when everything is going up and to the right, it's exciting to tie up a lot of land that you're then going to buy in the future. But if the market flattens, or maybe even your deliveries decline, and you don't have the appetite that you thought you were going to have, then it could be it can create some challenges. So it's essentially a deferred purchase, and ultimately you just need to be prepared to do the purchasing.
We live in kind of strange days of housing right now. Do you see anything in this market, this cycle, that feels like it's going to bring a change to our world, to your world?
I would love to have an exciting answer. I'm not sure that I do. And I'm not sure if you meant housing specific, or if you're talking about AI, or if you're talking about the Japanese, or if it's all of the above. But
all of the above, I would say. I'm glad you brought up AI too. Is that something that's going to change your world, our world in housing, do you think?
I am sure it will. I'm just not sure how. I think the builders are much further ahead of how it may transform their businesses than the investment bankers are around how it's going to transform our business. Like I see the same thing everybody else sees. I mean, it is amazing how quickly you can produce information. So, I know at our firm and at other firms, people are wondering, okay, well, is our staffing model going to need to be the same going forward? But for now, we really haven't changed very much, because we're busy, and if we're able to gather information more quickly, then we're able to deploy people more quickly to run with that information. So I don't see a whole lot of change happening in the M&A market, because at its core, I mean, if there's anything that's a very personal, relationship based, trust based process, it's selling someone's company. And so I think on our advisory side of the business, I just think it's going to remain a pretty people-centric, high-touch model.
That's a great segue to my last question. So Bob, pretend you're a private home builder and you're thinking about selling your business. What advice would Bob Crowley, the M&A guy from Moelis Company, give Bob Crowley, the small home builder?
Sure. So there are some obvious things, like, as I touched on earlier, you want to have not that you don't want to do better than your base case. You want to have a reasonable sense of valuation. You want to be prepared in terms of getting your acts together with materials and things like that. So those things are basic. That I think is maybe a little less obvious is that I think the key to getting a deal done, and ultimately getting a deal done at a great price, is finding the buyer for whom you're strategically important. And maybe you're in a market that they're not in. Maybe you've got people that they need. Maybe it's both of those things, plus that they have some internal growth objectives that you could help them achieve. Whatever it is, it's a different answer for each builder. But if on the front end you can determine the short list of builders or a builder that you think you'd be especially compelling to, then that's an important thing to identify, and it's not static. So a lot of those things I touched on are always evolving. So it's a moment in time. But then when you're making your decision, it's important to recognize that your decision to sell and your ability to get a successful deal done is in part your decision. It's largely your decision, but it's also a function of what's happening with the buyer. Sometimes someone will come and knock on the door and you'll say, I really like those guys. I think it makes sense, but I'm not ready yet.
Okay.
And ultimately, as the seller, you're the only one who can make that call. But I've seen many circumstances where someone decides now is not the right time. The buyer then goes off and does a different deal. And then a year or two later, the seller's like, okay, well, where's so-and-so? And there's always somebody else. So I think that, it's not an absolute, but when you're sort of coming up with your list and your decision matrix as to how to set yourself up for success, I think having a sense for the timing for the buyer that you think is the right buyer for your business, or the right couple of buyers, should be on that decision tree.
And since we're in real estate and real estate is always about land, do you think at the end of the day, if you're a builder, a potential acquisition, do you think it's just if you've tied up some really good pieces of land, especially in supply constrained markets, are you, the most attractive?
Yes, that's having a strong land position.
Yeah.
And two things. The land is critical. I think what's even better though is if you have the land, but you also have a demonstrated track record of success, because everybody says they have a great land position.
Mm.
But I think what the buyer is always skeptical or suspicious of is that somebody has run out and tied up a bunch of deals right before they decide to sell. They're sort of fattening up the pig, hoping to get a big multiple of book on land that is probably just kind of commodity retail like land. And so the second piece of that puzzle is if you have a good land position, but in addition, you have a home building company that's been able to achieve strong operating results. Like the operating results of your builder, in part, can serve as a validation of the quality of your land bank.
Okay.
So not only being able to tout that you've got a strong land position, but also be able to demonstrate that, hey, we've been selling houses and making money off of our land position, and the proof's in the pudding. That's kind of the winning combination.
That's a great point. I'm glad you said that. Well, Bob, I really appreciate you coming on. I want to do this, especially we just had an earlier episode that touched on this, but I wanted to look at M&A and acquisition from a more holistic perspective, and you're perfect. I appreciate that.
My pleasure. Thank you for having me on.
Awesome. Thank you all for listening. This is Dean Worley for the New Home Insights podcast. We'll see you again in a couple of weeks. Since you forgot to hit the stop button, I'm going to take a second to tell you about our weekly Building Market Intelligence newsletter. Over 40,000 smart folks get these timely takes on the housing market in their inbox every week, and you can too by heading to jbreg.com/subscribe and signing up.